Hello and welcome to this webcast providing an overview of the exposure draft Lack of Exchangeability published in April 2021. My name is Paolo Dragone from the ISB's technical staff. I'm joined here today by Tadeu Cendon, a member of the International Accounting Standards Board, and my colleague Jawed Dossani from the ISB's technical staff. Please note that any views we express today are our personal views and not necessarily those of the board of the IFRS Foundation. The exposure draft itself and further information regarding this project are available on our website. Today, we will talk about what the board is proposing and why. We have also included a question and answer section that will discuss some of the questions that were raised during the development of the proposals, and which may answer some of the questions you have on the proposals. We are very keen to hear your feedback, and at the end of our presentation, we'll discuss how to get involved. Before we get into the proposal themselves, perhaps I can ask Tadeu to walk us through some of the background and why the board decided to propose these amendments.
Thank you, Paolo, and hello, everyone. This project started from a question that came to the IFRS Interpretations Committee in the context of the situation that exists in Venezuela. And that situation is such that some companies with foreign operations in Venezuela have been unable to observe a spot exchange rate between the Venezuelan bolivar and, say, euros, when translating the results and financial position of their Venezuelan foreign operations. IAS 21 requires the use of spot exchange rate for the purpose of translation. So when no such observable rate exists, what rate should the company use? IAS 21 has some requirements for when exchangeability between two currencies is temporarily lacking. However, it is silent on when a lack of exchangeability is not temporary. This gap in IAS 21's requirements has led to diversity in practice, and although circumstances in which a currency is not exchangeable might arise relatively infrequently, when they do arise, economic conditions can deteriorate rapidly, and the diverse views could lead to material differences in the financial statements of affected companies. So, the board has decided to propose a narrow scope amendment to IAS 21 to address all situations in which exchangeability between two currencies is lacking. The board's objective is to improve the usefulness of the information provided to investors by requiring companies to apply a consistent approach to determining whether a currency is exchangeable into another currency and the spot exchange rate to use when it is not. The exposure draft proposes a two-step approach. In the first step, the company would assess whether a currency is exchangeable into another currency. If the company concludes that the currency is not exchangeable into the other currency, the second step proposes to specify how a company would determine the spot exchange rate. There would also be additional disclosures a company would be required to make in this situation. Javed and Paulo will now walk us through the board's proposal on these two steps.
Thank you, Tadeu. I will first talk about what exchangeability between two currencies means and how a company would assess that. This slide sets out the proposed definition of exchangeability, that a currency is exchangeable into another currency when a company is able to exchange that currency for the other currency. However, many factors influence exchangeability between two currencies, and the board recognizes that making this assessment could be complicated. So, the board is proposing to include application guidance and illustrative examples to help companies make this assessment. I will briefly touch upon the main aspects of the proposed application guidance. Firstly, an exchange transaction may not always occur immediately. This could be, for example, because of legal or regulatory requirements. So, the application guidance proposes that the existence of a normal administrative delay in obtaining the other currency would not preclude a currency from being exchangeable. What constitutes a normal administrative delay would necessarily depend on facts and circumstances. Secondly, a company would consider its ability to obtain the other currency and not its intention or decision to do so. So, for example, a company might have no intention of obtaining another currency because it considers the rate at which it could do so to be quite unfavorable. However, because the company is able to obtain the other currency, the currency would be exchangeable into that other currency. Next, a company would consider only exchange mechanisms or markets that create enforceable rights and obligations. Now, typically when exchangeability of a currency is administered by jurisdictional authorities, there are often parallel markets through which a company might be able to obtain foreign currency. In assessing whether a currency is exchangeable, a company would consider these parallel markets only if they create enforceable rights and obligations. In some jurisdictions, different exchange rates might apply for different uses of a currency. So, for example, a company might be able to obtain another currency to pay for imports of particular goods, but not to pay dividends. So, in assessing exchangeability between two currencies, it is important for a company to consider the purpose for which it obtains the other currency. In developing this proposal, the board built on the requirements already in IS 21 and decided that, firstly, when a company reports foreign currency transaction, it would assume that the purpose of obtaining the other currency is to settle individual transactions and assets and liabilities for those transactions. And secondly, when translating a foreign operation or using a different presentation currency, the purpose of obtaining the other currency would be to realize its net investment in the foreign operation or the net assets of the company itself. Now, finally, there might also be some situations in which a company is able to obtain only limited amounts of foreign currency for a specified purpose. So let's take an example. A company with a foreign currency denominated liability of, let's say, 1,000 units might be able to obtain only 50 units of that currency. The board decided to specify that in these situations, a currency would not be exchangeable into the other currency if the company is able to obtain no more than an insignificant amount of the other currency. So if the company is able to obtain only an insignificant amount of the other currency, the currency is not exchangeable. A company would assess the significance of the amount it is able to obtain for a specified purpose by comparing that amount with the total amount of the other currency required for that same purpose.
Javed, perhaps I can make a quick observation here. As we will shortly see, the board is proposing that a company would estimate the spot exchange rate when exchangeability between two currencies is lacking. And to limit the number of situations in which a company would estimate the spot exchange rate, the proposals for assessing exchangeability between two currencies are deliberately prescriptive, and the board expects exchangeability between two currencies to be lacking in only a narrow set of circumstances.
Thank you, Tadeu, and thank you, Javed. I will now talk about how a company will determine the spot exchange rate when exchangeability is lacking. As Tadeu just mentioned, the board is proposing that in these situations, a company will estimate the spot exchange rate. The board decided to propose conditions to be met when estimating a spot exchange rate, rather than proposing detailed requirements on how a company should make that estimation. Amongst other reasons, such an approach would be consistent with measurement requirements in other IFRS standards, and consider also that estimating a spot exchange rate can be complicated and depends on entity and jurisdiction-specific facts and circumstances. This slide lists those conditions. In particular, the proposal specifies that the estimated spot exchange rate should be a rate, firstly, at which a company would have been able to enter into an exchange transaction had the currency been exchangeable into the other currency. Secondly, that would have applied to an orderly transaction between market participants. And finally, that faithfully reflects the prevailing economic conditions.
Paolo, can I perhaps jump in here and maybe ask a question? So does this mean that anytime a company concludes that a currency is not exchangeable into another currency, it has to use a complex estimation technique to determine that estimated spot exchange rate?
That's a good question. The board has deliberately not included detailed requirements on how to estimate the spot exchange rate. So a company does not necessarily need to use a complex estimation technique. The company could, for example, estimate the spot exchange rate by starting with an exchange rate it can observe and then adjusting that rate as necessary to estimate the spot exchange rate. And that leads me on to the next slide. To reduce the complexity of estimating a spot exchange rate, the board also identified two specific situations in which a company will be permitted to use another observable exchange rate as the estimated spot exchange rate. The first situation is one in which an observable exchange rate for a different purpose meets the conditions of the estimated rate. For example, a company may be unable to obtain another currency to pay dividends or otherwise realize its net investment in a foreign operation. However, companies in that jurisdiction might be able to obtain that other currency to import goods. In such situations, the company is permitted to use the observable exchange rate for importing goods if that rate meets the three conditions that were listed on slide 10. The second situation is one in which exchangeability between two currencies is lacking at the measurement date, but has subsequently been restored. In this situation, the company is permitted to use the first subsequent exchange rate if that rate meets the three conditions listed on slide 10. To help companies assess whether the observable exchange rate in both these situations meets the conditions of the estimated spot exchange rate, the board has included a list of factors to consider.
As Tadeu mentioned earlier, the board is also proposing additional disclosures a company will be required to provide when exchangeability between two currencies is lacking. I will talk very briefly about these requirements. The board was informed that investors need information about the nature and financial effects of a lack of exchangeability, the spot exchange rate used, the estimation process, and the risk to which the company is exposed because of the lack of exchangeability. The proposed disclosure objective and the related requirements are designed to provide investors with such information. I will not talk about each of these requirements, but some of those are listed on the slide. The board also observed that some of these requirements are similar to those in other IFRS standards, so a company might already provide some of the information when applying those other standards. So the board has also proposed specifying that a company would not need to duplicate information that has been provided elsewhere in the financial statements. We will now discuss with Tadeu some questions that were raised during the development of the proposal and which may also answer some questions you might have on the proposals. Now, in applying the first step of the proposed approach and assessing exchangeability between two currencies, a company would be required to consider the purpose for which it obtains another currency. So, Tadeu, does this mean that two companies within the same jurisdiction might reach different conclusions regarding the exchangeability of one currency into another currency?
Javed, yes, that's correct. Each company assesses exchangeability separately, and in making this assessment considers the purpose for which it obtains the other currency. So let's consider, for example, a jurisdiction in which the relevant authorities allow a company to obtain another currency to import vaccines, but not for any other purpose. In this case, a company that imports vaccines might conclude that the currency is exchangeable into another currency for purpose of translating the vaccine transactions. However, another company that has a foreign operation within that jurisdiction might not be able to obtain the other currency for the purpose of realizing its net investment in that foreign operation. The company would therefore conclude that the currency is not exchangeable into the other currency for the purpose of translating the results and financial position of its foreign operation. In fact, even companies that assess exchangeability for the same purpose might reach different conclusions regarding the exchangeability of one currency into another currency. Let us, for example, consider two companies that are both translating foreign operations that have a functional currency of A into a presentation currency of B. There could be situations in which those companies are able to obtain a fixed amount, say 100,000 units of B, which is less than the total amount they would need to realize their net investment in their respective foreign operations. Applying the proposed requirements, both companies would assess the significance of this 100,000 units by comparing it to the total amount required to realize their respective net investments. Depending on the amount of the company's net investment in their respective foreign operations, that 100,000 might be insignificant for one company, but not for the other.
Thank you, Tadeu. Another question that has come up relates to the existence of a parallel or unofficial market. As the board has observed, when there are restrictions on the exchangeability of one currency into another, there are often unofficial markets through which a company might be able to obtain the other currency. The proposals say that when a company assesses exchangeability between two currencies, it will not be able to consider such a market if an exchange transaction in that market will not create enforceable rights and obligations. However, if it concludes that exchangeability is lacking and such a market does exist, will the company also be restricted from using an observable exchange rate from this market when it estimates the spot exchange rate? So when it is in the step 2 of the board's proposed approach?
Paulo, you are correct in saying that when a company is in step 1 of the proposed approach, when it assesses exchangeability between two currencies, it would not consider markets in which an exchange transaction would not create enforceable rights and obligations. However, when a company has concluded that a currency is not exchangeable into another currency, it would move to step 2 of the proposed approach and would need to estimate the spot exchange rate. As we have previously said, the board has not proposed detailed requirements on how a company should make the estimate, but has set out some conditions. The proposed requirements do not prohibit a company from using the observable exchange rate from an unofficial market as a starting point to develop its estimate. However, the company would need to adjust that rate as necessary to ensure that estimated spot exchange rate meets the 3 specified conditions.
Thank you, Tadeu. We have one final question for you. There might be some situations in which a company might not be able to exchange one currency for another currency, but it might be able to do so only indirectly. To take an example, a company might be unable to exchange currency A directly into currency C. However, it might be able to exchange currency A into a different currency, say currency B, and then exchange currency B into currency C. Some have asked whether in this situation, currency A is exchangeable into currency C.
A very good question. The board did consider these situations, and the proposed application guidance discusses this. In the example you just described, the company is able to exchange currency A for currency C, even though it might only be able to do so indirectly. So, in this example, subject to meeting the other requirements relating to the assessment of exchangeability, the company would conclude that currency A is exchangeable into currency C.
Thank you, Tadeu, for sharing your insights regarding those questions. It was very helpful. I will now wrap up the webcast by outlining the next steps and explaining how you can help. The exposure draft is open for comment until the 1st of September. The board plans to start discussing feedback on the exposure draft in the last quarter of this year. We invite you to comment on the board's proposals. This slide includes a link to the web page through which you can submit a comment letter, and links to other useful resources, including the project page and the exposure draft itself. This concludes our webcast. Thank you for your participation, and we look forward to hearing your views on the exposure draft. Goodbye.